When it comes to retirement planning, there are three major risks that we need to factor in to create a great retirement plan. Now, my name is Owen. I'm an advice-only financial planner and a CFP, and I'm the founder of Adviice. And when we create retirement plans, we want to look at a number of different risks, but there are three risks in particular that we need to focus on in every retirement plan. I can pretty much guarantee that all of you are thinking about one of these risks in particular, but are you thinking about the other two risks? Probably only some of you are thinking about these other two risks within your retirement planning. Understanding and planning for these three risks is important when you want to create a strong retirement plan. Now, the first risk that you're probably all thinking about when it comes to retirement planning is investment risk. Now, investment risk is the risk of a downturn early in retirement. This is sometimes called sequence of returns risk. It's basically the risk in the first 5 to 10 years of retirement of a large downturn in the stock market, so a large decrease in your portfolio value. Now, there's a couple ways to deal with this sort of risk. One way, and the cheapest way, is definitely diversification. A well-diversified portfolio is going to reduce your investment risk. We want to look at exchange-traded funds. We want to look at index funds. We want to look at geographical diversification. We want to have a lot of diversification in a retirement portfolio to help reduce investment risk. Now, the other way to manage investment risk is with asset allocation. So you might have a 60-40 portfolio, an 80-20 portfolio. You might have 60% of your portfolio invested in equities, stocks. You might have 40% in fixed incomes, bonds, and GICs. This helps balance the risk within your investment portfolio. Now, you might have 60-40 or 80-20 asset allocation. But the important thing here is that we don't want to increase other risks with the asset allocation. We'll talk about that in the next section, but we want to make sure that we're not taking one risk and then creating another risk because of that. Now, the third way some people address investment risk is with a cash wedge. So they might increase the cash portion of their portfolio, perhaps it's shorter term GICs. They might increase that in the few years before retirement and then draw that down in the first years after retirement. This can help manage a little bit of that risk. We want to make sure that the cash wedge is part of your fixed income asset allocation. We don't want to layer on a 60-40 portfolio and then a big cash wedge on top. Then you end up being too conservative in retirement. And being too conservative actually increases other risks, which we'll talk about next. Now, when it comes to investment risk, sometimes retirees make a mistake here. Sometimes they become too conservative with their investment portfolio, and that can seem like a good decision to reduce investment risk, but that increases other risks within the plan. Now, we'll show you an example of what that looks like within an actual retirement plan, but first let's look at the other risk that we want to manage in retirement planning. Now, the second big risk in retirement is inflation rate risk. For a long time, inflation rate risk didn't seem like a big problem. In the 2000s, 2010s, inflation was fairly low. And so for a long time, retirees didn't have to worry about inflation rate risk. But over the last few years, we've seen what higher inflation rates can do to a retirement plan, and it can be quite detrimental. So the impact of higher inflation is that your real investment returns can be lower than your target, what we need within the retirement plan. You still might be getting a 10% return on your investment portfolio, but if inflation rates are 5, 6, 7%, then your real return isn't enough to maintain your standard of living in retirement. And that's the risk of higher inflation impacting your retirement plan. Now, higher inflation rates in retirement can quickly erode the purchasing power of some retirement sources of income. So things like fixed income, bonds, GICs with fixed payments, coupons, things like pensions, for instance, that don't have an inflation adjustment. These are impacted very, very heavily by higher inflation rates. Now, to manage higher inflation rates, we actually want to invest in investments that have an inflation component. So equities go up with inflation. Equities are companies can increase prices. That's what inflation is. So one way to manage inflation rate risk in retirement is actually to have more equities within the portfolio. This is why we need a balanced portfolio. We need 60-40 or 80-20. We can't be too conservative in retirement because although that increases or decreases our investment risk, it actually increases our inflation rate risk. So we need to balance those two risks in retirement. I want to show you what investment risk and inflation rate risk look like in an actual retirement plan. So we're going to look at Jennifer and Michael here. You might recognize Jennifer and Michael for some of the past videos and case studies that we've done. They've got a fairly good plan. Their net worth looks quite good. They've got $1 million of assets here. They've got a bit of pension income. They're going to draw down their non-registered first. Then they're going to switch to registered. They're going to leave their TFSA to last until age 74 or 75. Overall, their spending is quite healthy at about $80,000 a year. They're going to add to their TFSA while that non-registered account still exists. And then a late retirement, they're going to go down to about $60,000 a year after age 80. Makes a lot of sense. They've got a big go-go phase, and then they're going right to a no-go phase in between. Now, their net worth looks quite healthy. If we look at this in other financial planning software, this might look like it might have 100% retirement funding. We might be 100% of a retirement funding goal, maybe 110 or 120%. Other retirement planning software does this sort of straight line decumulation, but we know that that's not realistic. Retirement does not happen in a straight line. Retirement has different ups and downs depending on inflation rates and investment returns. And so this isn't a realistic retirement plan. Makes a nice chart, pretty chart, nice graph, but it's not what actually retirement is going to look like. And that's why we do the success rate analysis within Adviice. So within Adviice, we are testing the same decumulation plan that we just saw, but we're testing it over different periods of historical stock returns, bond returns, and inflation rates. And so some of these lower lines here, they represent periods of high inflation or poor investment returns. So it could be periods like the 1970s with high inflation of 10, 12, 14%. It could be poor investment returns like the Great Depression or after 72 with the big stock market crash. Those periods are very challenging for retirees. And in this case, it does look like there's a risk of running out of money. So 30% chance that Jennifer and Michael will have to make an adjustment to their spending if they want to be more successful in retirement. Now, 7 out of 10 times, 70% chance of them having quite a bit of money left over. But 3 out of 10, they'd have to make an adjustment to their retirement spending to be successful. The nice thing is the AI strategies does that work for us. Instantly, we can see that within their plan, they need to reduce spending by anywhere from $6,000 to $12,000 a year, and they will be almost 100% successful. So 92 to 100% successful. So we already know what it takes for Jennifer and Michael to have a very successful retirement plan, but don't get fooled by the straight line decumulation plans that a lot of financial planning software does. It might look like it's 100% funded in terms of retirement funding, but that's not really the case unless you're doing this sort of Monte Carlo or aft casting within the plan. Now, reducing spending is one way to increase the success rate of a retirement plan if you're faced with these very poor investment returns or high inflation rates. Now, the other way you might be thinking is we might want to decrease the investment risk within the plan. So in this case, we've got an 80-20 asset allocation for Jennifer and Michael. That's in line with their risk tolerance, their risk capacity. But you might be thinking, well, let's decrease the risk here by maybe choosing a balanced investment portfolio. And I'm going to show you why that doesn't necessarily work within a retirement plan. Decreasing investment risk might actually increase other risks within the plan. So let's increase that or decrease that to a 60-40 asset allocation. We'll be more conservative in retirement, and let's see what happens to their projection and their success rate. So here, if we look at net worth, we see that there's not as much money left over at the end. There's not as much buffer there. So that's one of the things that happens within the plan is if we're more conservative, we have a lower expected rate of return. We don't have as much money towards the end of the plan to tap into. Now, the other thing is the success rate is actually worse. Now we've got a 56% success rate. And that's because although we've decreased the investment risk, we've actually increased the inflation rate risk. We have less investment returns over a long retirement period. And for Jennifer and Michael, they're retiring at 55, so they've got a long period that they need to be planning for. So when we think about investment risk and inflation rate risk, don't just look at the asset allocation. There are more factors that you need to consider, because just reducing your investment risk, being more conservative, might actually increase the overall risk of your retirement plan. If you're enjoying this video, I'd love it if you like and subscribe. That helps us reach more people who are creating their retirement plans. If you want to create a retirement plan like Jennifer and Michael's that we just saw, if you want to evaluate what your retirement risks look like, your inflation rate risk and your investment risk, I would highly recommend signing up for Adviice. Adviice is just $9 a month. It's the same platform that I use with my one-on-one retirement planning clients, my advice-only planning clients. I charge thousands of dollars for those types of retirement plans, but you can access Adviice for just $9 a month. You get access to the platform, the community for support, as well as the bi-monthly webinars and videos that we do with case studies and different examples of retirement planning. If you haven't started a retirement plan yet, if you haven't thought about your investment risk, your inflation rate risk, your other risks in retirement, I would highly recommend create an account and start your retirement planning today. Now, the third risk when it comes to retirement planning is actually longevity risk. It's the risk of having a long and healthy retirement. When we have a long and healthy retirement, we need that money to last for a very long time, sometimes 30 or 40 years if you're retiring early. That creates a big risk if you have a long and healthy retirement. That longevity risk is something that we want to manage within every retirement plan. Now, the challenge with longevity risk is that we need that money to last for a very long time. There can also be healthcare costs towards the end of retirement. All of these factors can be very, very challenging if we have a very long and healthy retirement. We don't want to see retirees run out of money in their 80s or 90s, and so longevity planning is a very important piece to every retirement plan. Now, the Financial Planning Standards Council, they put out guidelines every year that every CFP in Canada should be using for their retirement planning. And the chance in their guidelines, the chance of living into your early 90s, late 80s is actually quite high, in particular for couples. For couples, the chance of one person in the couple living into their mid-90s is quite high. And this is why we want to focus on longevity planning within a retirement plan. The risk of having a long and healthy retirement is especially important for couples who are planning retirement together. Now, there are a couple ways to manage longevity risk within a plan. Delaying CPP or old age security can be great for longevity risk. It can help provide fixed income payments like pension payments all the way throughout retirement. Defined benefit pensions are also great for longevity risk. If you don't have those, or if you don't want to delay CPP and old age security, then purchasing an annuity can be another way to manage longevity risk. If you have a long and healthy retirement, then you're actually benefiting from an annuity because the insurance company continues to pay that out as long as you are living. So annuities, delaying CPP and old age security, pensions, these are all great for longevity risk and reducing longevity risk. Now, the final way you can manage longevity risk is just to know how much you can spend in retirement in the different phases. Retirement risk, longevity risk is very, very sensitive to how much you're spending. Over 30 to 40 years, your spending rate and how much you're spending in retirement has a big impact on how much you'll have towards the end. So making sure that you're not spending too much in early retirement, mid-retirement, or late retirement is an important factor to manage longevity risk. Within every retirement plan, we want to have one scenario which has a long and healthy retirement, and then we want to have other scenarios with maybe a shorter life expectancy. There can be different recommendations depending on the length of the plan, the life expectancy within the plan, but we need at least one scenario to look at what the plan looks like if we have a long and healthy retirement. When it comes to retirement planning, you need to be balancing these three risks. They are in competition a little bit. Decreasing investment risk will increase inflation rate risk or longevity risk. We need to balance those risks within a retirement plan. If you haven't created a retirement plan yet, I would highly encourage you to do so that you can understand the trade-offs between these different risks within your unique plan. Thanks so much for watching. I'd love it if you like and subscribe, and we'll see you at the next one.